Hi, everybody. We are going to go through the chapter 13, practice midterm. Okay, so hopefully by now you have seen the slides for chapter 13, the lecture for chapter 13. You may have even been able to take some time to look at this file with the that's posted in e-learning with the questions for chapter 13, practice midterm. And then I'm going to go ahead and go through these with you so you can kind of see some of my thoughts on these questions. And keep in mind that going into next week, we're going to have a comprehensive practice midterm, which will contain practice midterm questions from chapter 10, 11, 12, 13. There'll be multiple choice questions, and there'll also be at least one, maybe two examples of what a format type question will look like. And I'll be giving you more information about that in next week's lectures. I'll go through that more comprehensive practice midterm, and we'll spend next week prepping for our midterm, and then the week after that we'll take the midterm, and I'll be giving you more commentary on that. Okay? All right, good. So I just want to go ahead and start to go through this. And this first question, when cash is received from customer in the form of a refundable deposit, the cash account is increased with a corresponding increase. Well, say somebody gave me $10,000, right? And they said, hey, that's a deposit and you need to refund that deposit to me, then we would have to credit a liability, customer deposit, whatever. Okay, I'm just giving a name to that liability. Okay, it's a liability though, would show in the balance sheet in the liability section of 10,000. And then later on, depending on the nature of the agreement, if we have to refund that deposit, so I guess they're telling me, they're giving me the terms there, it's refundable. Later on, when I give that money back to them, I, of course, would debit the liability and credit the cash. Okay? Okay, good. But that's a current liability. Take a look at number 2, a discount on a non-interest bearing note. So non-interest bearing note, just to recollect back to our lecture, non-interest bearing note is a note in which they basically say, hey, the note is going to mature for $104,000, and they don't mention interest, but they only loan you $100,000. They only give you $100,000. You're going to have to pay back what? $104,000. So let's just say someone gives me a non-interest bearing note, and they sit there and tell me that the note is going to be a 4-month note. And they're going to sit here and tell me that I have to pay them back a full $104,000 at the end of that note, right? They give me $100,000. So when they loan me the money, I'm going to get cash. I'm just going to do the journal entry with that. I'm going to get cash of $100,000. I'm going to credit the liability. Of course, it's going to be a current liability because it's only a 4-month note. I'm going to credit the liability for $104,000, right? And then I'm going to have to, of course, make this journal entry balance. What I'll do is I'll debit discount on that note payable for $4,000. Now, on the balance sheet, let's say they loan me this money, I don't know, say they loan me this money on 11/1, okay? Or just say, don't worry about the date, because I'm going to show you another question in a second. They loan me this money, okay? And immediately after they loan me this money, I'm going to prepare my balance sheet. I'm just going to do the liability section of the balance sheet. I would show what? I would show note payable. My note payable is what? 104. And then I would report the discount. And the discount is what? 4,000. Discount on note payable. And then I would show the net NP, guys, is going to be note payable. The net note payable of 100,000. Okay, and then of course I would amortize that discount into interest expense over time, which is something that I'm going to basically go ahead and show you on this next problem. Okay, so let's see how this would work. Jane's Donut. Okay, borrowed $200,000 on January 1st, 2018. Oh, did I tell you the answer? That I think I'm jumping too quick here. So that's called a Contra Liability. It's against the liability. It's called discount. The discount on that is called a Contra Liability. Okay, so that's what's happening. The discount on a non-interest bearing note is going to be this $4,000 in this example. That's the discount. That's a Contra Liability. We're going to deal with a non-interest bearing note here coming up in a question. And so, well, I don't know, actually we're not. So let's just continue this thought. Sorry guys, I think that I'm getting another example confused with this one. Okay, so let's just keep going with this. So they loan me this money like this, right? And let's say they loan me the money, so do worry about the date, on 11/1, okay? And as soon as they loan me that money on 11/1, I would show this, okay? That's on 11/1 if I had prepared a balance sheet on 11/1. Now, let's say we come to the end of the year. Say this is 11/1, 2021, whatever, okay? And then we come to 12/31, 2021, and we want to prepare our balance sheet. Well, now we would have to amortize some of that discount, okay? So I said it's a 4-month note. So that means that what? We have gone ahead and we've taken that $4,000. We divide it by 4 months. It's a 4-month note. Okay, so that means we're going to amortize $1,000 of that discount each month. Okay, so we would have had what? All of November, all of December that we should have amortized the discount. So what we would do, we would debit interest expense, and we debit interest expense $2,000. Okay, so we might be making an adjusting entry at 12/31, all of November, assuming we didn't, amortize the discount and accrue that in November. All of November, all of December, we get around to the end of the year, we go ahead and accrue this interest. We would debit interest expense, we would credit discount for $2,000. We're still on this problem number 2 here. I'm just sort of co-opting some of this space down here for not relevant to this question. I'm just borrowing some of the space here. Okay, and then if we prepared the balance sheet at that point, okay, at 12/31, 2021 balance sheet, the note payable is still what? Still showing at $104,000. But now we've done what? We've credited the discount. We had debited it up there for 4. We credited it for 2. So now the discount is showing $2,000 and the note payable is showing $102,000 at this point, showing that we have now come closer to owing that full $104,000. And then of course we would continue into the next year, and when we finally pay that off, we would go ahead and have amortized the complete discount, debit the note payable $104,000, credit the cash paying back the full $104,000. So the takeaway, even though the note says non-interest bearing, we are calculating interest expense, right? Okay. Now that is different than what we're showing here. Now we can go to number 3, in which they actually tell us the interest. So we got Jane's Donuts, borrowed some money, January 1st, 2018, 12%. Interest is payable in full at maturity on January 1st, 2020. So it's a 2-year note. In connection with this note, Jane should report interest expense. Okay, we're supposed to be talking about current liabilities in this chapter, and here we go with a 2-year note. but the mechanics of calculating the interest is not, different than it would be if this was an interest-bearing short-term note, a current liability, and that the interest expense is what we borrowed times the interest rate. And since they borrow it on January 1st, and they're asking us the interest expense at December 31st, that note was outstanding for the entire year, so we would come up with $24,000. Okay. Now, on this question, we stick a little bit better with the theme of current liability because it's a 12-month note, interest-bearing. We borrowed $500,000, but now we borrow that money on November 1st, and they want to see the interest payable at December 31st. So now we would sit there, use the interest rate that the note calls out, and we borrowed that money November 1st, all of November, all of December. That's 2 months out of the 12-month year. And so we would go ahead and debit interest expense for $5,000 and credit interest payable here for the $5,000 to accrue those 2 months of interest, and that's going to happen at 12/31. Okay. All right, good. So non-interest bearing note, we still have to recognize a discount for the difference between the amount borrowed and the face of the note. So they say it's non-interest bearing, but there is interest. The interest is the additional amount you're going to have to pay when you finally pay that note off, the $104,000 in that example. You still have to accrue interest expense, but rather than set up interest payable, you use this discount account to put your credits into as you amortize the discount, if you will. That brings the note closer to its final maturity amount that you're going to have to pay, which will be this, in that example, $104,000. If it's an interest-bearing note, you simply apply the interest rate for the period of time the note was outstanding to calculate your interest expense, and you have this account interest payable. Okay? Okay, good. Let's go ahead then, and let's continue on and take a look at number 6 here. Okay, so M Corporation has an employee benefit plan for compensated absences that gives each employee 15 paid vacation days. Okay, vacation days can be carried over indefinitely. Employees can elect to receive payment in lieu of vacation days. M estimated that there are 200 total vacation days available at December 31st, 2018. M's employees earn an average of 150 per day, and it's December 31st balance sheet. What amount of liability for compensated absences is M required to report? And you look, and they can be carried over indefinitely. Employees can elect to receive payment in lieu of vacation days. All of that is telling you that, the benefit here, the compensated absence, right, vests to the employee. Thus, we have met the criteria for recognizing a liability because they're either going to take their vacation or we're going to have to pay them out when they leave. Okay, so we have what? 200 vacation days, $150 a day. So what we do in 2018 is we'll debit, compensated absences or compensation. Okay, it doesn't have to be compensation. Compensated absences, compensation. Expense, we debit that for the, what did we say, it was 30,000 when we did our calculation, and we credit the compensation payable, whatever the liability. And there's no real, I'm never going to give you a choice that, test, do you know the exact, we call it compensation payable, wages payable. I may ask you, is it a liability? Yes, it is. We would credit the liability, compensation payable, liability, right? That's a liability, $30,000. Okay, so what amount of liability for compensated absences? Okay, again, I'm not going to get all tangled up in the name of the account. I would call it out as what it is, a liability, and that's going to be credited for $30,000. Now that assumes that the employees didn't take any vacation, And notice we record that expense at whatever they're making at the time that they earn the vacation. Now, if they're making a different amount later, then we would have to adjust our expense for the increase in salary that would be being paid at the time that they take the vacation. Don't worry about that right now. We're going to look at another question in a second that will deal with that potential occurrence. Okay. Number 7, when a deposit on a refundable container is forfeited, the firm holding the deposit will experience, and the word forfeited is key here. That means we didn't have to give the deposit back to the person. So when they give us the deposit, we debit cash, making this number up, 50,000. We credit what? Deposit liability, 50,000, making that number up. Okay, and what happens? Then whatever the terms of the agreement are such that, hey, you give us this deposit, but if you use these containers for, at the end of the 5-year contract, the terms are that you have to forfeit the deposit. And as long as you keep these containers and use them for 5 years, then then at the end of that 5 years, we don't have to refund any of the money back to you. Then at that point in time, we would do what? Debit deposit liability for the 5,000 and credit revenue. That's a revenue. Okay. In effect, you sold them. Okay. You sold them the right to use that equipment over time, right? And you have to look at the terms and conditions of the agreement. If the terms and conditions of the agreement say, hey, only if you hold it for the 5 years can we keep the money because now you've used it the whole time, fine. If there's a refundable clause in there, then I'll carry it as a liability. And then when I have to give the money back to them, say at the end of that 5 years, instead of crediting revenue, I'll credit cash because I'll be giving them their cash back. Let's say it says that we will prorate what we return to you. Well, that would mean over 5 years that we earn what? We earn $1,000 per year. If it was a 5-year deal and they gave me 5,000 deposit, I earn 1,000 a year. So each year, at the end of the year, I would debit the deposit liability and credit the revenue. And I can go on with notions of how we would recognize revenue from a non-refundable deposit, a partially refundable deposit, etc. It really depends on the terms of the contract that you have with them. And then, of course, in a testing situation, you'd have to read the question carefully to understand, what the terms are and recognize the revenue or whatever, the return of the deposit accordingly. Okay, good. Let's go ahead and let's take a look at this next one. And I find that for a lot of these questions, the trick is making sure you know what they're asking you for. And for the most part, with these questions that have some computations involved, they're either asking you for the expense or the liability. What's the expense? What's the liability? So don't get caught up trying to calculate the expense when they're asking for the liability, or of course vice versa. We don't want that. Okay, so you take a look and we see on January 1st, 2018, G Corporation agreed to grant all its employees 2 weeks paid vacation each year with the stipulation that the vacation earned each year can be taken the following year. Okay. For the year ended December 31st, 2018, G's employees each earned an average of 800 per week. A total of 500 vacation weeks were earned in 2018 and were not taken during 2018. Well, thanks for telling me that, but it just said they can't take it till the next year, but fine. Thank you for telling me that we're not taken during 2018. Wage rates for employees rose an average of 5% by the time vacation actually was taken in 2019. What is the 2019 wage expense? Okay, well, first, let's figure out what the amount of vacation is here. Okay, you're going to get to watch me calculate this as I go because I made the mistake of calculating it on my calculator and then not writing any of it down. But that's fine. Okay, what? For 2018, okay, 2018, at 12/31/18, they're going to look and they're going to say, well, 500 vacation days, okay, times what? Times $800, 500 vacation weeks times $800 per week. So I multiply that times 800, okay? And if I'm doing my math right, that gives me 400,000, right? So at 12/31/2018, which I already wrote that and I'm writing it again, I'm going to go ahead and debit compensation expense. I'm just going to call it comp expense, okay? Compensation expense for what? 400,000. And then compensation liability, I'm going to credit for 400,000, right? Because they earned that in 2018 at the 2018 prevailing wage. Now what happens? They actually go ahead and take the vacation, and they take the vacation in 2019 when their salary is what? 5% more. So what happens? And you can see the calculation here. Well, 500 times what they were making in 2018, and then if you increase that, you take 5% of that total, they're making 20,000 more on that vacation time that they're taking in 2019 than what it was in 2018. So what would I do? Well, I would go ahead and I'm going to credit the comp liability. I'm going to debit, sorry guys, debit the comp liability for 400,000 because they're now taking that vacation time. I'm going to debit comp expense. And I'm going to debit that for 20,000 because I have to pay them what? 20,000, 5% more over and above what they earned as vacation time in 2018, because they're going to want to get paid at whatever the prevailing wage is in 2019. And then I would credit cash 420,000, right? Okay. So an employer doesn't sit there and go, well, wait a minute, when you earned the vacation, you're only making this much, so we're going to only pay you that much when you actually take your vacation in the next year, 2019, whatever. It doesn't work that way, right? You want to be paid at what you're making at the days you take off. Okay. So they know they're going to have to pay you at that higher wage, but only 20,000 of that is compensation expense that's related to the year when you take it. Only, would I say 20%? Only 20,000 of that. The 400,000 was an amount you had earned from work you had done last year that we simply liquidate the liability for that amount. Okay. Okay, good. Number 9, Peterson. So the compensation expense. Sorry, guys. Sometimes once I kind of told you how to calculate the answer, I forget to go back to the problem and point out that was the answer. The answer was B. That's your compensation expense. Even though you paid out cash at 420, which was one of the choices, 400 of that is a liquidation of liability. The expense is the additional 20,000. Again, important to know what it is the question is asking you for, because they kind of, for a lot of these, and you'll see this on your exam, I'm going to be, sort of toggling back and forth between asking you about the expense versus the liability. Okay. Okay, good. Number 9, Peterson Photoshop sold $1,000 in gift cards on special promotion on October 15th, 2018, and sold $1,500 in gift cards on another special promotion on October 15th, 2018. Of the cards sold in October, 100 were redeemed in October, 250 in November, and 300 in December. Of the cards sold in November, 150 were redeemed in November, and 350 were redeemed in December. Now, this is very important here. Peterson views the probability of redemption of a gift certificate card, of a gift card, as remote if the card has not been redeemed within. Okay, I'm going to go ahead and let that go since I seem to have to sneeze in every lecture. You can go ahead and enjoy that one. Sorry, guys, okay? Peterson views the probability of redemption of a gift card as remote if the card has not been redeemed within 2 months. Now, wait a minute. They had issued $1,000 worth of gift cards in October. So we go November, we go December. So they pretty much feel that all of those gift cards that were going to be redeemed should have been redeemed by December. Otherwise, they're not going to be redeemed. So at 12/31, we're past that 2-year mark. So at that point, I look at this question and I say, well, I don't care how many gift cards they sold in 1,000. It is remote that there will be any gift card redemption for any of those amounts in October. I know they redeemed some, but we don't expect any more to come in because we're past that 2 years. It's remote that will happen. And so they want to know, well, what should still be deferred revenue for the gift cards? Well, that's for the gift cards that we sold that we still think have a chance of being redeemed. Okay, so you take a look at this one now and you say, well, if that's the case, if I'm sitting here and I've got these gift cards that are issued in November, right? And that was what? $1,500 worth was in, okay, it was sold in November. Okay, so December 15th, I'm thinking by January 15th we'll be in remote, but that's in the next year. So for 2018, I still am expecting potential that some of those will be redeemed. So I'm going to sit there and take the $1,500. And then I need to look to see, well, what's already been redeemed, okay? So we sit here and we say, of the cards sold in November, okay, so those aren't going to expire until what? January, December 15th, January 15th. So there was 150 that came in on those. And then there's another what? Another 350 that came in on those. That means that there's still what? There's still 1,000 out there that I don't think the chance of their being redeemed does not become remote until what? Until January 15th of the next year. So I would still have to show that 1,000 is an unearned revenue, and then I could take it out of unearned and put it into earned revenue what? As they're redeemed, or until we get past that 2-month period, January 15th, then I can just go ahead and say, hey, I think that's it. No more are going to come in. And so I don't have to, carry any more unearned revenue for those because we're past the 2-month mark. Okay, good. So as you look at these questions, guys, most important thing here, I think, are the 2 important things. One, know what account you're looking for. You're looking for the liability, you're looking for the revenue, you're looking for the expense, and then it becomes a reading comprehension. Okay, do I understand what the nature of the agreement and the nature of the estimate here is, etc., and you're able to work your way through the questions. Okay, good. Number 10, when a product or service is delivered for which a customer advance has been previously received. So what does that mean? Customer advance. Well, that means they gave me the money before I earned it. It happens. People say, hey, you're the most happeningest rapper in town. Here's $5,000 and be available for a concert when I schedule it going forward, right? So since you haven't provided the rapping yet, okay, you would debit what? Unearned revenue. Then what happens? Then a little bit later, the person calls you, says, hey, can you perform at my party next week? I'm going to throw a big rapping party. Need you to come and do your thing. And you say, okay, fine. You show up. You do a good job. The person pays you. Okay, so now what? Now you can go ahead. Well, they've already paid you. They paid you in advance. So now you can go ahead. You've done the rapping now. So you can go ahead and debit unearned revenue. 5,000 and credit the, not credit cash, but credit what? Revenue, because you've earned that now. Guys, sometimes you'll see in a solution or something, the book will show you credit earned revenue. Don't do that. That's for babies, earned revenue. Okay, if you just say revenue, okay, you're a big accountant now. You say revenue, that means it's earned. You don't have to put the word earned in front of it. Okay, good. So debit to the liability, unearned revenue, and credit to revenue. And that's what we did there. Okay, good. Number 11. In May 2018, Raymond Financial Services became involved in a penalty dispute with the EPA. Okay, just makes you wonder how the EPA got involved with an outfit named Raymond Financial Services. It seems like it should say Raymond Coal Company or Raymond Drilling for Oil Company, but somehow this financial services company got in a dispute with the Environmental Protection Agency. I'm not sure how that happens, but anyway, at December 31st, I'm sure you could be called Raymond Financial Services and have some environmental impact somehow. I don't know. Anyway, at December 31st, 2018, the environmental attorney for Raymond indicated that an unfavorable outcome of a dispute was probable. Okay, there's the magic word. Probable. We're thinking, hey, as long as it's probable and we can reasonably estimate the amount that's going to be paid out on a settlement here, we're going to have to book a liability for that. The additional penalties, which I don't know what they mean by additional penalties, but the penalties were estimated to be $770,000, but could be as high as $1,170,000. Now, when I look at that, I start thinking, maybe they're going to make me pick the range or something, right? Because when I can't come up with a solid estimate that I think is, a good, most probable estimate, then I have to do what? Book the lower end of the range and disclose the range in the financial statements, okay? But then it says that after year end, but before the financial statements were issued, Raymond accepted an EPA settlement offer of $900,000. Well, wait a minute. Then before I issued the financial statements, right? Because I'm looking at this estimate and thinking about how I'm going to have to disclose this estimate and this range. And then I get better information. I get the information, best evidence that was what? Direct personal knowledge. I know I settled for $700,000. Well, I don't have to ignore now that information, even though it wasn't paid out until the next year. I now have a good, solid estimate of what my liability really was at December 31st, 2018 in this case. So I would go ahead and debit my, fines, I guess, whatever they would call that account for the $900,000 and credit fine payable, whatever. Okay, they might have some more fancy names for these, but the liability is going to be $900,000, which is what they asked here. Okay, and you're saying, well, wait a minute, John, you said we booked 770 or one. Yeah, if that's the best information you've got, then you would have to book the lower end of that range. But before we were issuing the financial statements, God came down and said, hey, this is the amount, $900,000. Well, thank you for that beautiful prediction. I'm going to use that to prepare my financial statements at 12/31/2018. Okay, good. Number 12, on December 31st, 2018, L Inc. had $1.5 million note payable outstanding, due July 31st, 2019. L borrowed the money to finance construction for a new plant. Okay, so I probably should have read that as one sentence. It's not any new information. They're just telling me they borrow $1.5 million to construct a new plant. L planned to refinance the note by issuing long-term bonds. Okay, so I'm going to refinance this note by issuing some bonds. Okay, so I'm going to issue the bonds, and then I'm going to take the money for the bonds, and I'm going to use it to retire this note, okay, to pay off this note. Because L temporarily had excess cash, it prepaid $500,000 of the note. It prepaid $500,000 of the note on January 23rd, 2019. So I had this money that I had borrowed, and I had this 1.5 still outstanding at December 31st, and then in January of the next year, I paid down 500,000 of that. In February 2019, L completed $3 million bond offering. L will use the bond offering proceeds to repay the note payable at its maturity and to pay construction costs during 2019. On March 31st, 2019, L issued its 2018 financial statements. What amount of the note payable should L include in current liabilities section on its December 31st, 2018 balance sheet? Okay, now look, I paid 500,000 of that, okay, and I didn't pay it until January 2019. So I know that 500,000 was still outstanding as a liability at 12/31/18. I know that because they didn't pay it, or they paid 500,000 in that next year. So I know that that was still outstanding. So then the question becomes, okay, and I used cash, a current asset, to pay that in that early part of that very next year, a few days after December 31st, 23 days after December 31st. So I know that that 500,000 was still a current liability at 12/31/2018 because I paid it off, and 500,000 of it in 2019. And so I used a current asset that was available at December 31st, 2018. I used that current asset to pay off a liability, thus it is a current liability. So I knew that at 12/31/18, that 500,000 was a current liability because I didn't pay it until that next year, okay? But what about the remaining $1 million now, right? Because it was 1.5 million. I paid off 500,000 using my cash early in the next year. So the 500,000 was a current liability, but then I secured refinancing for that additional $1 million. Should I carry that then at December 31st, 2018 as a current liability, or should it be non-current? Well, what are the rules? The rules are what? If you actually execute the refinancing before you issue the financial statements in that next year, and we didn't issue the financial statements until what? Until March of 2019, then I can carry that long-term debt that I've secured the refinancing for before the issuance of the financial statements as non-current. So that $1 million is what? That's going to be non-current, okay? And therefore what? And therefore, what amount of note payable should we include as a current? It's just the 500,000. The $1 million, I've secured the refinancing before I issue the financial statements under US GAAP. I can carry that as a non-current liability. And the reason I mentioned US GAAP, even though we're not going to get into a lot of differences between US GAAP and IFRS in this class, under IFRS, you would have actually had to have secured the refinancing before the balance sheet date in order to be able to have this treatment of treating that as a non-current. Under US GAAP, if you secure the refinancing, you actually carry out the refinancing before the issuance of the financial statements, then you could carry that as non-current. Now that is a little bit different than what we said. And this example is something that I mentioned that wasn't on the slides. The slides themselves talk about a contract to refinance. And if it's a contract to refinance, so I don't actually secure the refinancing, but I have a contract that is going to allow me to refinance, then we get into that if the contract is executed before the issuance of the financial statements, then can go ahead and carry that debt as non-current. If the contract isn't signed until after the balance sheet date, then that liability still would have to be carried as current. So there's a difference between having a contract to refinance and actually executing the refinance, which is what they did in this case. before they issued the financial statement, so they could carry that as non-current on their 2018 financial statements. Okay? Okay. All right, good. Now we come over and let's just look at this next question. Liabilities payable within the coming years classified as long-term if refinance is completed, not a contract to refinance. The refinancing is completed before the issuance of the financial statements. That, as I just told you, is the rule for US GAAP. So again, the refinancing has to be completed. If you just have a contract to refinance, someone's saying, hey, talk to me. Okay, if you need some money, I'll go ahead and I'll give you the money to refinance. Just sign right here. And you have a contract to do that. Well, then you have to look at that contract. You haven't actually executed the refinance, completed the refinance. You have a contract to do so. If you decide you want to do it, contract exists before the balance sheet date, then that liability can be carried as non-current. Contract isn't signed until after the balance sheet date, then you're still going to have to keep that debt as a current liability. Okay? All right, good. Number 14. Gary Company estimates it is probable that it'll receive a $10,000 gain and pay a $4,000 loss contingency. Okay? After recording the appropriate journal entry to recognize the contingent amounts, Gary Company's net assets will, net assets. Net assets are what? Assets minus liabilities. Assets minus liabilities equals what? Stockholders' equity. Stockholders' equity consists of common stock, additional paid-in capital, and retained earnings. So this is a funny way of asking you what is going to be the impact on retained earnings because of this. And retained earnings is beginning balance of retained earnings plus what? Net income minus dividends. And so now you lock in on what? Okay, so what they're really asking me is what is going to be the increase or decrease in net income as a result of this information that they give me up here. Okay, so that's sort of thing you have to untangle a little bit here. At first, what do they mean by net assets? Okay, good. So now we know, okay, they're asking me about income, and you start to look, well, what are the rules for me to be able to take a gain contingency will increase my net income versus a loss contingency, which will decrease my net income? And they tell you that it is probable that they will receive a $10,000 gain contingency. Now remember, we said in the lecture that it has to be a high probability in order for you to take a gain contingency. And remember, I said because these are so unusual, gain contingencies, what's happened is because there are specific instances in the US GAAP standards where we will take gain contingency, since there's so few that they had to create a conceptual framework umbrella to fit these things under. So they say, okay, a high probability of a gain, but the reality is that you deal with gain contingencies in the more detailed provisions for when they'll let you take a gain contingency. For example, a tax carry forward benefit, then that could be something that would be recognized as having a high, and you would take a gain in advance for something like that. But that is a very specific instance that we'll get into Chapter 19. So gain contingencies, for your purposes, you can pretty much say, yeah, they're out there, but they're so rare that I'm going to always assume that when I see a mention of a gain contingency, I'm not going to take that, unless it's fitting under a very specific umbrella of things that we have talked about. We didn't talk about, this didn't use the word high, and it's not falling under a particular area that we really haven't gotten into much yet, and so you're not going to take that. Loss, we do what? Loss, it is probable that they will pay a $4,000 loss contingency. Well, now I'm going to book that loss for $4,000. I'm going to debit loss. I'm going to credit contingent liability, right? I have to book that because it is probable and estimable, and they told me the amount. Okay, so that makes it estimable. So what happens? That's going to decrease my net income, thus decrease my retained earnings, thus decrease my net assets by $4,000. Okay, good. Number 15. A company should accrue a loss contingency only if the likelihood that the liability has been incurred is probable and, of course, has to be reasonably estimated. Okay, and again, if you can't come up with a reasonable estimate, disclose. If you could come up with a range, then you would book the lower end of that range. If you come up with reliable information that gives you a nice precise number to take as the estimate of the amount of the loss, take that amount, and having had to have paid a certain amount or agreed to a settlement for a certain amount before you issue the financial statements is incredible evidence as to the amount. And so that's why we took that 900,000, whatever it was in that previous question. Okay, good. Let's take a look at number 16. And as part of a promotion campaign, Funzy cereal includes 1 coupon in each issue of various national magazines and offers a toy car in exchange for the $1 and 3 coupons. Can't wait to get that new car. I just give them $1, 3 coupons, I get this car. The car costs Funzy $150 each. Okay, so they're gonna have to go purchase these toy cars, and then they'll give you the toy car if you give them 3 box tops and you give them the $1. Okay, so the cars cost some Funzy. Okay, if they cost them $1.50, their net cost on that car is what, 50 cents, because they're making their loyal customers give them up 50 cents in order to get the car. How are you going to send them 50 cents? I don't know. I guess you'll send them a 50-cent check, or you'll glue 2 quarters to a piece of paper when you send that in. Okay. Experience indicates that 4% of the coupons eventually will be redeemed. And during the last month of 2018, the first month of offer, 12 million coupons were distributed and 240,000 were redeemed. What should we report as promotional expense for the coupons? Now, what's happening? We're motivating people to buy our product on the opportunity to get this cute little toy car. Okay, so that is what we're having sales in. What year are they asking me? 2018. Based on this offer of the 3 box top is being traded in 50 cents for the car, right? So if that's the case, then let's figure out how many coupons are going to come up. And if it's what? It's 12 million coupons, right, that have been distributed. But to get the car, they have to give us what? Of the 12 million, they say only 4% have been redeemed. So that means that 480,000, we estimate 480,000 coupons are going to be redeemed. We issued 12 million were distributed, but only 4% come back. So we're thinking, okay, there's going to be 480,000 of these fools. I mean, these people that send in the coupons and buy the cars. But when they get to get the car, they have to give us 3 of the coupons. So 480,000 divided by what? 3 coupons means that 160,000 little toy cars are going to have to be issued, because it takes 3 coupons to get 1 car. But our net cost, because they also have to send us 50, they have to send us in 50 cents or $1. How much do they have to send us? Sorry, guys, they don't send us in $1. They send us in what? 50 cents. I misspoke. They got to send us in 50 cents. So the net cost of the car is not 50 cents, but it's $1, right? $1.50 is what it costs the car. Our customer sends us 50, so our net cost on I got this backwards, guys. I'm sorry. I'm not going to cut it. The car cost us $150, and they have to send us $1 in. So that means the net cost of the car is what? 50 cents. Okay, so the customer sends us in $1. The car cost us $1.50. So we're going to end up net having to pay out 50 cents per car to when we get those cars. Their net cost of them is going to be 50 cents. So 160,000 times 0.5 equals what? Equals 80,000. So what will we do? Using all of our information here, right? We have 12 million coupons out there. 4% of the people will turn in the coupons, but they got to get us 3 to get the car. So that means we're going to have to, incur costs of for 160,000 cars, which our net cost is 50. The car costs 150, but the person sends us $1 with the coupons. So we're going to do what? We're going to debit promotion expense, whatever, 80,000, and credit promotion liability. $80,000, right? Which is the answer to this question. Now, you look at that and they say, but John, it says that 240,000 of the coupons are redeemed. Yeah, okay, so of these 480,000 that we're thinking are going to come in, 240,000 were already redeemed, okay? And again, it takes 3 of those to get the car. So 240,000 divided by 3 gives me what? Gives me 240,000 divided by 3 should give me, I don't do anything without a calculator, guys. I'm sorry. I put these numbers in my calculator and then I forget to write them down sometimes. I should know that 240,000 divided by 3, of course, is 80,000. I don't know why I had to use a calculator for that. 80,000. And then 80,000 times what? Times 0.5, the net cost of the cars equals what? Equals 40,000. So that means we had to do what? We had to buy $40,000 worth of these little cars. And so what happens? We're going to go ahead and debit the promo liability, that account, right? We set it up based on our estimate, but then we've got some actual numbers coming in. We go ahead and we credit cash to pay for those cars. Okay, so that's why if the question asks you what is the remaining balance in the promotion liability account, the answer would be 40,000, choice B. In this question, they ask you what's the expense. The expense is matched with the sales for that year, right? And so since we sold enough for 12 million coupons, then we have to take the expense based on our estimate of what will come in on those. That takes the expense in 2018, okay? So again, I could give you the same exact question, okay? Note, I could give you the same exact question, and all I got to do is change it to what should be shown as promotion liability on the balance sheet at December 31st, 2018. Then the answer is B, 40,000. Okay, I like questions like that because I know that I've helped you with that, but I know that I'm not asking you the same exact question on the exam, but I'm asking you something that's very, very similar to what I'm not asking you the exact question I asked you the practice midterm, but I'm asking you a question that's very, very similar, and I'm known to do that. Okay. Okay, good. Number 17. Okay. At the beginning of 2018, Angel Corporation began offering a 2-year warranty on its product. The warranty program was expected to cost Angel 4% of net sales. Net sales made under warranty in 2018 were $180 million. 15% of the units sold were returned in 2018 and replaced at a cost of 5.3. The amount of warranty expense. Okay, so you need to get out of the mode of looking at the cash that they paid out as potentially being the answer for the cost of the warranty, or the warranty expense, I should say, the warranty expense. The expense is what? Is based on your estimate of what's going to come in on the warranty. And since they say it's 4% of sales of 180, you can see the calculation down here, we would debit warranty expense and we debit that, 7.2 million, okay? And then we would credit warranty liability. What is it? 7.2 million. That's million, okay? Then, as the claims start to come in, then we go ahead and we debit warranty liability, 5.3, and we credit the cash because we're now paying out, right, for that warranty, whatever it was, for repair to replace, whatever. We would credit cash 5.3. Maybe we would credit inventory if we replace it, whatever. Okay, some asset account is going to get credited there. It wasn't relevant to being able to answer this question. Now, again, as I said in the lecture, sometimes students will be like, oh, I don't understand that because it's 5.3. What happens if more comes in? Don't worry. We sit there and each year as we make sales, we put more in the liability account, right? So there's plenty to debit out as we pay on those. And look, if we have this horrible product that's blowing up all over the place, then I guess maybe we better put a little bit more in the liability account, debit the expense account, change an accounting estimate. You don't have to restate anything. You just go forward with that new estimate and you keep trying to do the best you can to keep that estimate as reliable as possible, doing your homework, talking to your engineers and whatnot, so that hopefully there won't be this huge variation between what we're setting up as a liability year over year and what we end up paying out. But we don't go back and restate anything. We just base it on our best estimate based on our sales generally of what we made during the year, and then we go ahead and write the liability off against actual claims, and we just keep going forward in this. And you're saying, wow, that sounds really clumsy. Accounting is full of accounting estimates. That's why we put in our financial statements. One of our first footnotes in the financial statements is a footnote about risks and uncertainties, and we talk about estimate uncertainty in that footnote so that users of the financial statements know that there's a potential that, hey, things will be, the actual outcome of some of these things will be different than what we're putting down at any point in time, okay? That's why we were so in love with that situation for that contingent liability when before we issued the financial statements, we had the final outcome determined. Thank you. And we used that for our estimate, even though it was more than an estimate, it was the real thing. But we had that information before we issued the financial statement, so we grabbed onto that. Okay. All right, good. Let's take a look at number 18. In 2018, Holy Oak Inc. offered coupons for $20 off of qualifying purchases for its new line of product. Holy Oak sold 10,000 of these products during the year. By the end of 2018, 7,100 had been redeemed, and the $20 reduction of purchase price provided to the customers. Holy Oak historical experience with the coupons indicated that 85% of the indicates that 85% of the customers use the coupon. I'm one of these people that every coupon I get goes straight in the garbage. Okay, so that 85% of the people are going to use this coupon. Of course, it is a $20 reduction. I don't know. Maybe I should be taking a better look at those coupons. Maybe some of them are like $20 and I'm throwing $20 in the garbage, but I have trouble keeping track of coupons. Anyway, stop, John. What is the promotional coupon liability that Holy Oak should report in its December 31st, 2018 balance sheet? So they're asking me the liability, okay? And they're sitting there and they're saying that 10,000... is right over here, is what they sold, and they tell us that and they get a coupon with each one of those, and they tell us that 85% is what they think will be redeemed. And I guess that makes sense because it's worth $20, right? Who's going to throw away $20? So 8,500 is what's expected. Already redeemed is what? 7,100. They gave them the discount on sales, right, for 7,100 of those. So that means that there's still 28,000 outstanding. Okay, now just let's kind of go through and think through that a little bit to see what what the journal entries might be on that. And so I'm going to go ahead and erase some of these lines that I put over here. I think you see how we got the 8,500. So that's the 10,000 times the 0.85. So I'm going to get that out of the way. I'll write it right here. 10,000 times 0.85 is the 8,500. That's where that came from, but now that doesn't look like 10,000. 10,000, okay, times 0.85 is where the 8,500 came from, okay, just so we have that there. And then let's go ahead and let's take a look at this. If you think you're going to have 8,500 of these things getting redeemed, and you're thinking that that's going to add up to a cost of $20 per those of discounts you're going to have to give on, future sales, right? So 8,500 times 20, that's $170,000, right? Okay, so based on your estimate that 85% are going to be redeemed, you would debit some sort of, coupon liability for 8,500 and debit coupon expense for 8,500 and credit coupon liability. Okay, for 8,500. Then what happens? Then they tell us that 7,100 of these things actually got redeemed. Okay, so for the 7,100 that got redeemed, 7,100, guess I can write that over here. All right, the 7,100 now times the $20 means that there was 142, not 7,100, yeah, it means there's 142,000 that have been redeemed, meaning there's still the 28,000 left, which is basically that calculation there, which was the answer to this question, because that means there's still liability for the 28,000 because you sat there. Okay. Coupon expense is not 8,500, guys. It's 170,000. And coupon liability is 170,000. Okay, that's what went into the liability account. But 142,000 came in. So what did you do? You debited the liability, 142,000, right? And you would have credited your sales for 142,000, because remember, you're giving a discount on those items, right? And then of course you would have had other sales that would have come in with those at that point in time. Okay, so when you debit this liability, that's how it gets down to this 28,000. Okay, all right, so those are still outstanding, and then those remaining supposedly 28,000 would come in maybe next year, because by December 31st only 7,100 had come. There's still a few outstanding, and so that's going to be 28,000 that will go into that next year, and you'll take those out of the liability and credit the sales at that particular time. Okay, good. So let's go ahead and let's take a look at the next question. Okay, number 19. Which we have this Panther company had quality insurance warranty liability of $350,000 at the beginning of 2018 and $310,000 at the end. Warranty expense is based on 4% of sales, which were $50 million for the year. And what is the warranty expenditures? Okay, now when we talk about expenditures in accounting, that's not the same as expense. Expense means that the future economic benefit has expired. Expenditure means that you actually paid the cash. So when we say expenditure, we're saying to you, hey, what did you spend? So you buy a new vehicle for your business. You do what? You debit an asset account, not an expense account. You debit an asset account, say 100,000. You credit cash 100,000. Your expenditure on that was 100,000. Your expense is not the 100,000. You put that in an asset account. So they're not asking you for the expense here. They're asking you for the expenditure, what cash was paid out in honoring these warranties. Okay. So when they give you a question like this, where they start asking you a piece of what is affecting a particular account, you have to figure out what account are we talking about. And the account that we're talking about would be the warranty liability that would be affected by this transaction. And in that warranty liability account, you'd have what? You'd have the beginning balance. Okay, those are amounts that you hadn't paid out on yet at the beginning of the year. Okay, you would add to that what? You would add to that your warranty expense. Okay, then you would subtract what you actually paid out on the warranties, and that's the question they're asking, because remember, expenditure means what did you actually pay out on these, so we know we're going to have to figure that out, and then you'd end up with an ending balance. Now, in this particular question, right, they gave me the beginning, they gave me the end. So I like to set those up like that. Well, they gave me the beginning, they gave me the end. The amount that gets added is the warranty expense for the period, and they tell me that the warranty expense is 4% of sales on 50 million. So I take that 50 million times 0.04, 50 million times 0.04. That's so annoying that I figure out the number and then I don't write it down. There it is, times 0.04. I did write it down in this case. Is what? Is 2 million. Okay, 1, 2, 3, 4, 5, 6, 2 million. So they must have debited warranty expense. I'm going to put this in general journal form down here, 2 million. They would have credited the warranty liability based on sales for the year for 2 million. Okay, well, that's the add. It's a liability. To increase the liability, you credit it. So that's 2 million. Okay, so then I come up and I always like to give myself a little subtotal. It helps me to get to the answer. That's why I like to do it, because I like to get the answer. So I have what? I have my warranty expense of 2 million. I add that. That gives me subtotal, squeezing the subtotal of 2,350,000. Then I look and I say, well, okay, I had as much as 2,350,000. I ended up with what? With 310. So if you start out with 2 million, I do a little side calculation. If you start out with 2,350,000 and you subtract from that what? 310, then that difference becomes what? Becomes 2,040,000. Okay, 2,040,000, 2,350,000 minus 310, 2,040,000 is what must have been subtracted from 2,350,000 to end up with what? 310. In other words, I made a journal entry. Now I'm really crying for space here. Okay, I got some down here. So I must have made a journal entry to do what? To debit the warranty liability for $2,040,000, and I credited cash of $2,040,000, right? That's the amount that was subtracted. That's the amount that was my expenditure that I paid out on this thing, okay? And so the answer is $2,040,000, all right? So it's very similar to an analysis like you do with the allowance. It's just mirror image, the allowance for doubtful accounts. The allowance for doubtful accounts, you do what? Debit bad debt expense, credit the allowance, right? When the write-offs actually come in, you debit the allowance, you credit, not cash like we're doing here, you credit the accounts receivable, right? So it's really the mirror image of what you would do with your allowance for doubtful accounts. It's not even a mirror image. It's just that the debits and credit direction are the same. It's just that the allowance is a contra asset, whereas this is actually being shown as a liability. But the logic is very, very similar to what you do with your allowance for doubtful accounts. Okay? Okay, good. And this is just a way of figuring things out where they don't tell you, questions they ask you at the beginning and the ending balance are pretty easy, but if they're asking you about the amounts that were expended, I could give you the same question and change it to the warranty expense. Then you'd have to work your way up to see what the warranty expense. I don't tend to do this at this level for questions, but you get into, say, the CPA exam or something, they could ask you for the beginning balance. I probably won't do that, but I could have asked you for the expense in this case as opposed to the amount of the warranty that was paid out. Okay? Okay, excellent. Let's go ahead then finally and look at number 20. Extra processes is involved with innovative approaches to finding energy reserves. Extra recently built a facility to extract natural gas at a cost of $12 million. However, Extra is also legally responsible to remove the facility at the end of its useful life of 20 years. This cost is estimated to be $17 million, the present value of which is $6.5 million. What is the journal entry for the asset retirement obligation? We have to do what? We have to add to the cost of the asset, $6.5 million, but then we also have to what? We have to use the present value number. We have to credit an asset retirement obligation liability for $6,500,000. And then we're going to have to sit there and do what? We're going to have to sit there and calculate the interest costs on this since we're using present value. And we're going to have to amortize this part of the asset plus whatever other equipment was being added or pieces of this equipment was being added to the asset account over the useful life and amortize that liability, bringing it up to the eventual future value, which will be $12 million at the time when we're finally going to have to clean this thing up. Okay. When you get to be my point in life, the kinds of exciting things you do, when you're not working is thinking about stuff that you've talked about in your lesson. And so I don't know if this is the case or not. Of course, my throat's going to go out on me here, but it seems to me that the Environmental Protection Agency should require entities to make deposits against the estimate of what their asset retirement obligations are going to be at some point in time. So if you're sitting there and you're saying, well, look, I'm going to have to cough up $12 million and I'm going to have to cough up $12 million at the end of, 6 years, let's say, okay, then go ahead and make them make a deposit, okay, a funding, And, you can include a growth rate in there, whatever the interest rate would be. It's a simple, funding problem. How much does Johnny have to save per month so he can go to college? How much does his parents have to save so he can go to college? Well, you could turn this into a savings account decision. Is how much will I have to deposit each year for each of the next 6 years at a interest rate of X to be able to have 12 million to clean this thing up at the end. And they should have to put that money in escrow. And I'm trying to figure out why I didn't consider that a recommendation when I was put on an assignment, trying to figure out why coal companies, mining companies often would make a mess of the environment and not clean things up afterwards, and then just walk away from the thing and just leave a mess there and pretend like they were going out of business. Meanwhile, they reemerged as another company on the other side, and there were legislative barriers to allowing the Office of Surface Mining to keep those individuals from opening up a new company. So they would destroy the land over here, just walk away from that corporation, start a new corporation, and start a mess over there. So it seems to me, and I don't know why I didn't think of this when I was on this assignment, why don't they simply make them deposit whatever? And you want to have a growth rate in there, an interest rate in there, fine, but deposit an amount each year so that we're getting close to a reliable estimate of what the pot of money will be that's available for you to be able to clean this thing up at the end of the project or the life of the coal mine or whatever it is. So anyway, just a thought that I had here recently. And I don't know, maybe they do that now. I'm not sure. Okay. All right, good. So way beyond the scope of what we're talking about here. Take an asset retirement obligation for the present value of whatever it is you're going to have to pay to clean this thing up when you're done. Take the asset, take the liability, depreciate the asset, amortize that liability, and you'll be set for your asset retirement obligation accounting. Okay, guys, that's enough. Since I'm losing my voice, I'm going to call it a day there. And I will see you with your practice midterm. It'll be comprehensive, chapter 10, 11, 12, 13. And I'm going to be giving you the full-blown questions here pretty soon. So stay tuned for that pretty quick here, okay? All right, guys. Study hard.